We see it deducted from our paychecks. We might be receiving monthly benefits, but do we really understand the taxes that the Social Security Administration collects, or how those benefits are calculated? It's time to find out. I'm the Tax Geek, and here is Social Security, oversimplified. I'm not going to bore you with the historical background of the Social Security system. If you're interested in that information, it's linked in the video description. Medicare is also not covered, since that deserves a video or two of its own. The Social Security system covers most American workers. Workers not covered by the Social Security system are railroad workers who have a separate system that provides similar benefits, some local government workers that have an equivalent contributory pension plan, some students working under work-study programs, members of religious sects that are opposed to the concept of social insurance, who can opt out of the system and forfeit any benefits, and non-resident alien workers. Social Security benefits are financed by a 6.2% payroll tax levied on both employees and employers. The employer collects the employee's share of the taxes through payroll deductions and forwards them, plus their own portion, to the Social Security Administration. Self-employed people pay both the employer's and the employee's share, totaling 12.4% of 93.65% of net business income. This is collected by the Internal Revenue Service in the form of a self-employment tax and forwarded to the Social Security Administration. Social Security taxes are collected on the first $168,600 in wages or net self-employment income. If an employee works multiple jobs where the total wages exceed this amount, they are eligible for a refundable tax credit of any excess tax collected. If Marvin, for example, makes $105,000 at one job, then switches to another job where he earns $75,000, Marvin's employers would have collected between them $11,160 in Social Security taxes, which is $707 more than the current maximum tax of $10,453. He'll claim a refund of the excess tax on Schedule 3, Part 2, Line 11, which is carried to Line 31 of his Form 1040. The Social Security Administration pays out several different types of benefits. The most common benefit is the retirement benefit, which pays a monthly amount to people when they retire or reach normal retirement age, which is currently 67 for those born in 1960 or later. For most people, it's a mystery as to how their retirement benefits are calculated, so I'll attempt to oversimplify the process as much as possible. Every worker that is paid into the Social Security system has an account. This doesn't, as many believe, contain money that the Social Security Administration has set aside for your retirement. Instead, the SSA keeps track of your earnings for all of your working life. The first step in calculating your benefits is to determine your average indexed monthly earnings, or AIME. The Social Security Administration takes a look at all your annual earnings, and for the years before you reach age 60, applies an index to those annual earnings to compensate for inflation. Once the indexed annual earnings are calculated, the SSA selects the highest 35 indexed earnings years. These annual earnings are then added together and divided by 420, or the number of months in 35 years. If you have fewer than 35 working years, the SSA will use that number of years to calculate your AIME. This average indexed monthly earnings is then used to calculate your primary insurance amount, or PIA. The PIA is calculated by taking 90% of the first $1,174 in AIME, then 32% of AIME between $1,174 and $7,078, and 15% of AIME over $7,078. So let's look at Marvin again. Suppose his average indexed monthly earnings are $8,300. His primary insurance amount would be 90% of the first $1,174, or $1,056, plus 32% of the difference between $7,078 and $1,174, which comes to $1,889, and 15% of the remaining $1,222 in AIME, or $183. Adding the three figures together gives Marvin a total primary insurance amount of $3,128. Once calculated, the primary insurance amount is the monthly benefit you would receive if you start collecting benefits at your normal retirement age, or as a disability benefit were you to be judged permanently and totally disabled at any age. You can start to collect retirement benefits as early as age 62. If you do so, your benefit will be reduced by 30% of your primary insurance amount. If you start collecting benefits between age 62 and 67, the reduction percentage will shrink as you reach normal retirement age. If you decide to delay collecting benefits after your normal retirement age, your monthly benefit will be increased by 8% for each year you delay collecting benefits, up to age 70. Using Marvin as an example again, his primary insurance amount gives him a monthly benefit at normal retirement age of $3,128. Should he start collecting his benefits at age 62, he would receive 30% less, or $2,502 per month. If he delays collecting benefits until age 70, he would receive 24% more, or $3,870 per month. You don't have to stop working when collecting retirement benefits. However, if you start collecting benefits before your normal retirement age, your benefits will be reduced based on your earned income. For 2024, if you're collecting benefits from age 62 to 66, any earnings over $22,320 will reduce your benefits by $1 for every $2 you earn. Any earnings over $59,520 in the year you reach normal retirement age will be reduced by $1 for every $3 you earn. If this occurs, you will receive a letter from the Social Security Administration and probably have to repay any excess benefits you received. You can repay this amount by sending the full repayment to the SSA or agreeing to deductions from your monthly benefits. Benefits are only decreased by earned income from wages or self-employment. Other income, such as pensions, retirement withdrawals, interest, and investment income do not affect your Social Security benefits, although they can make some of them taxable, which is explained in my video on how Social Security benefits are taxed. Once you reach your normal retirement age, you can earn as much as you want with no effect on your retirement benefits. There is no means test for collecting Social Security benefits because you, by contributing, are considered to have earned your benefits as a right. It is not unusual to see very wealthy or high-earning older people collecting Social Security benefits. There are, of course, many more details to Social Security contributions and benefits. The best place to learn about them is to go to www.ssa.gov, where you can see your earnings record, calculate future benefits, apply for benefits, and much, much more. You'll find this linked in the video description along with additional resources and information. If you found this video informative, please give it a like and share it with anyone else who could find it useful. Subscribe to the channel for more oversimplifications of our overcomplicated tax system. And your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.